All right, welcome back to the Atlanta Construction Podcast. Today we have a special bonding and surety episode. We have with us here in the studio in Halifax, Ryan Brady and Jen Love. Ryan and Jen are both with Intact Surety. Ryan, before joining the surety industry, Ryan grew up in Dartmouth and he's a SMU grad.
I am.
I've been there myself and live close by at the moment. He began his career in the banking industry, transitioned over to the surety industry in 2003 as an underwriter, and he spent the last 5 years with Intact as a specialist and manager. We also have Jen Love. Jen's also part of the surety underwriting team at Intact, born in Miami, Florida.
Yeah, it's a long way from home.
A long way from home. Moved every couple of years with a military family growing up, and landed here in Halifax at what point? Is it 2005?
I was 17.
Okay, wow.
So that would have been 97. Yeah.
Well,
yeah.
And after graduating as well from St. Mary's University, moved into her career starting in 2007, and is currently with Intact as a surety specialist. And we also have with us today Andrew Cartwright from FCA Surety. Andrew is zooming in from Toronto. I believe your office is downtown. Is that correct, Andrew?
Yeah, just the Young and Davisville in Midtown. So
great. And Andrew was in the surety industry for about 15 years, working for a large national surety company in Trisura. He moved to Halifax to start up the Atlantic branch of Trisura, and ultimately returned back to Ontario in 2015. Andrew is now with FCA Surety as of September of 2020 and is the VP of Surety, managing their surety operations across Canada. FCA is a 100-year-old insurance broker specializing in construction insurance and bonding. Andrew prides himself as being a member of his client's advisory team and not only providing bonds, but helping contractors grow their business, managing risk, and dealing with complex business issues. Thanks for being here, guys. Really appreciate it.
For sure.
awesome, my pleasure. Yeah.
Very happy to be
That's
here.
quite the intro.
Yeah, that was impressive.
Good job.
Yeah, thanks for joining us from Toronto, Andrew. It's I think a neat dynamic that we have Intact as a surety company and FCA as a broker to kind of cover the basis and try and get a good perspective on the bonding and surety side of things. So I think that's a great start. I think, for some of our listeners, whether they're from general contractors or subcontractors, a lot of people are familiar with the terms bonding and surety. Maybe don't know or to drill in enough to know a lot of exactly what it is, but filling out the paperwork and understanding a few things. But maybe it's an opportunity, just kind of like surety 101, bonding 101, starting with the difference between insurance and surety. It's just as a point of reference and kind of move from there.
Sure. Yeah.
So if anyone wants to chime in and kind of roll that out.
Yeah, I can jump in on that, sure. So we often explain this to our clients all the time, the difference between surety and insurance. And at the end of the day, if you're a contractor, you're pulling a request for tender, you're pulling some project specs, and you're taking a look at that, and you're saying, if you don't have it set up already, you're saying, look, I got to get this stuff, and you're not always the expert. You're out there, you're building, and you're creating projects. And so in the simplest terms, insurance is an insurance company's taking a look at the chance of something happening. For example, your house burning down, and they're saying there's a 1 in 1,000 or 1 in a million chance of that happening, and X is the premium for that risk. And if a house burns down, they pay out that premium and they rebuild your house. Surety is a little bit different, right? It's a 3-party arrangement. You have the surety, you have the owner of the construction project, and you have the principal, which is the construction company. And in essence, what the surety company is doing is they're lending their balance sheet to the contractor and saying to a project owner like NSTIR or the City of Halifax Department, they're saying this contractor is good and they're going to complete the work in accordance to the terms and conditions of their contract. And as long as they do that, everything's great. And if not, then you hit a few bumps in the road. But that's in essence the difference between the two products.
Tell us a little bit just the basics of how a bond works, how a surety bond works.
Yeah, there's a few different types of bonds.
Mm-hmm. Performance bond,
exactly.
bid bond.
And I think the easiest way to explain it is to kind of walk through the process where if a contractor sees a job that they want to bid on, then that's when they need to look for a bid bond, which they're coming to us. Well, first they're going to Andy, but then eventually comes to us saying, we want to bid this job. We need to put up a bond that guarantees that will enter into a contract if awarded. And that's where we're saying, yes, we've vetted out these contractors, we've pre-qualified them, and we're vouching for them. That's what it comes down to, is that we're willing to stand behind these contractors when they're bidding a job. And should they decide not to enter into the contract for a multitude of reasons, that's when the bid bond penalty may come into play. Whereas if the owner, like HRM or NSTIR, has to go to the second bidder,
Right.
there's going to be a difference in the tender price. That's where we come into play on the bid bond.
So essentially, you're protecting the financial interests of the end consumer.
That's
Absolutely.
Right, the owner, yeah.
Maybe
And just can I just
go
jump in?
for it.
Like,
Yeah,
just
of course.
jump in about what on the bid bond itself. It's really the most important the time for us as a surety, because you're pre-qualifying that contractor at that point. Because you're saying if they are a low bidder, you're actually going to enter. You're going to enter.
Take on that risk.
If they enter into
Yeah.
that contract, you're going to take on that risk. So the bid bond for us is probably the most important time, because that's when you're doing all your vetting and you're looking at the tender specs and you're reviewing everything. And like you said, you're letting the owner know that we've done all the work on our end. We're comfortable supporting this contractor.
And these bid bonds are for general contractors where they're bidding to the owner, and a performance bond would be more for a subcontractor underneath the general. Is that correct?
Most often,
Yeah.
I'd say there are cases too where generals, and Andy may
Yeah.
be able to jump in too, but where generals may want to see bid bonds or agreement to bonds
Sure.
from those subtrades as well to
Yeah.
make sure that their prices are solid.
Yeah, you're seeing it more and more. Like it's a great point, Ryan. Like as many contractors know, the sort of trend of prompt payment is really sort of sweeping across Canada, and it started here in Ontario, and New Brunswick have it with their Construction Remedies Act, and there's a number of other provinces that are going through that. And so as part of that prompt payment legislation, bonding's actually become legislated. It's become law. And so in Ontario, for example, any publicly funded project over $500,000 must have a bond. And so you're seeing more use of bonds from public owners that didn't always ask for them, but that's cascading into GCs and private owners like developers that are now saying, maybe we should use this as a tool to mitigate risk for ourselves, right? Because from the standpoint of a GC, like if you're on a job and you posted a bond to HRM, ultimately you're managing the project. But if you have an issue with a subtrade, HRM's not going to say, oh, we understand your electrical trade's having issues. They're going to look to you as a GC and your bond, right? So as the GC on that project, you want to be making sure that you're pre-qualifying your subtrades correctly, you're vetting them as best you can, and then in addition, getting some coverage, like getting a bond from that subtrade, so that if it's a key critical path component of the project, that you have some coverage there that you can rely on if there's a problem, right?
Yeah, guys, outside the public tender realm, I know Andrew, you just mentioned private. You're seeing a lot of that in Ontario, and are we seeing that more and more here as well with private developers with large projects, or not as much?
Not so much here.
Not
no.
enough.
Not enough at all.
I
No,
think
because
if-
if you look around downtown Halifax,
Yeah.
most of it is all private, and I don't even know if much of it is bonded at all. It definitely wouldn't be.
So what's the risk there? I mean, what kind of trouble can that cause if those large projects are not bonded?
It would depend on the obligations under the contract. For instance, if there's any hard deadlines to be met, I would imagine a lot of these larger developments that the banks and the financing companies would want those jobs to be bonded to ensure that where that money's going towards isn't going to be thrown away.
And and so that money is there to protect the end consumer, the owner of the building project, where if someone couldn't complete the work, someone else can step in.
Absolutely.
And that
right.
money is there to help complete the project, continue the flow of work, continue to.
Yep, that's correct. Our bonds are always outstanding. Our bonds are in effect for the owner. They're there for their benefit. They're the purchaser of the bond.
Right.
Yeah, and it does two things, Dan, right? Number one, protects the owner. So from a developer standpoint, if they're not getting bonded and they have an issue with one of their contractors on site, and they have to sort of go through whatever remedies they have in their contract, defaulting and terminating that contractor, they've got a half-built project. They've got to find another contractor that's willing to come in and complete that work. And it's highly unlikely they're going to be willing to do it at the same price as the original contractor. There's some financial loss. And then in addition, like from the contractor's perspective, the coverage is for the owner. But what bonds do is it allows contractors to separate themselves from others, because as Jen said, they got to go through that pre-qualification process. So a bond company is going to look at your team, right? Like, what's your estimating team look like? How long has the business been around? What's the project management expertise? How do you tackle projects? What's the financial wherewithal of your company? And so if you can go through that process and secure a bond, you're gonna be bidding against a smaller pool of bonded contractors to pick up that work. So there is a benefit there to the contractor as well.
Yeah, thanks for that, Andrew. Maybe, I know maybe you'd like to use the analogy of a mortgage broker example with how the process works, and FCA being a broker, Intact being a surety company. Andrew, you just mentioned how you'll look at a company's systems, you'll look at their background, their history, their project history, and those kind of things. Maybe just talk a little bit about the broker surety relationship when a contractor comes to a broker, and then the surety company has to, dissect some information about whether it's just the contractor or, whether there's other variables that come into play when you're going to decide to go forward with a surety on a bond, and how that process works.
Sure.
Yeah, I think Intact will have a bunch to say here as well, but at the end of the day, that relationship really works at its best when the broker and the surety and the contractor all work together, and that relationship is strong. But it's, having sort of been in Atlantic Canada and done surety there, it's very different than Ontario, right? There's still a lot of what we call direct-ish relationships where contractors still work with the surety companies, and really what the broker does, and I've seen a lot of those deals, is they work really on behalf of the contractor, right? So they have a really good sense of what all the different markets are doing. So Intact and its competitors, and they can get a sense for where's the best fit for that contractor, where are the best terms that are out there, and then in addition to that, advising them on how to manage risk, like we sort of talked about at the beginning, and how to grow their businesses. Because at the end of the day, brokers are working with clients across the industry. They're often working with lawyers and accountants as part of that process. So they really have a good sense of the landscape of construction and sort of what the cutting edge is in any given field.
Mm. That was a really good summary, Andrew. And I just wanted to kind of go back to when you had mentioned in the beginning, like the three-party arrangement. That's the arrangement on the bond itself, yes, but like our broker is so key to that relationship and to the whole structure. We really wouldn't have a structure without them. So it's wanted to make a point that insurance, we aren't direct writers, so we go through brokers like Andrew, and they're very key to our business because again, they're the ones that
they're bridging the gap.
They're bridging the gap. They know the markets. They know all the markets. They know the contractor. They're the biggest advocate for both sides. For
sure.
Really.
Yeah. And so for you guys at Intact, Jen and Ryan, are you guys taking things into perspective in the market, the current things like COVID or labor shortage or supply chain stuff, and that's putting more onus on the bonding that you're underwriting. So all those things come into play as well, right?
Without a doubt.
And do those things, maybe speak a little bit on those things, and then do those things affect the premiums? Typically for contractors, it's between 0.5 and 5%, I think, maybe, or usually around 1%, something like that.
It's a good standard.
Yeah.
5%, that would be.
That's a little high.
5%, we'd be really happy.
How are the premiums affected by these things and these variables that are external?
Sure.
Yeah.
First and foremost, I think, again, going back to the difference between bonding and insurance. Insurance, they have actuaries to determine, how much we're going to charge based on the risk. For us, first step is yes or no. Like, we're not going to accept every risk. We're going to say, we're going to pick and choose what our good risks are. And then pricing usually revolves around their credit worthiness. We're looking at their balance sheet. We're looking at their past experience. And then when you're talking about things that are happening externally, COVID, labor shortage, that sort of thing, that's where the relationship is key. That's where, not just with us and the broker, but us and the contractor, and sometimes even the owners. We're having conversations with the different levels of government.
Yeah, to get that data.
Right.
That's got to be hard data to confirm as well, right? I mean, it's coming from the relationships that you have, or is there right?
Atlantic Canada is relatively small.
Yeah.
Thank God.
Small community.
And I'm sure Andy has a better appreciation, having been playing in both fields, both in Ontario and here. We get to have a lot of these one-on-one conversations. When we're talking about COVID, we're talking to our contractors and our brokers and finding out face-to-face, how do these affect them directly? How does it affect them indirectly? What steps have they taken to mitigate a lot of these risks in terms of what happens if you can't get on site? What happens if you can't find people to fill those roles? What if an outbreak happens while you're there? All these factors have to be taken into consideration. Supply chain management was a huge issue. Tariffs with the price of metal, that became an issue. And all these things that we're saying, okay, which one of our clients, which one of our partners are affected more so than others? We're looking at the ones that we have more of a vested interest in, ones who have quite large capacity. They're obviously more exposed than others.
Yeah. Andrew, maybe just to piggyback off what Ryan just said, I mean, you've worked on both sides in Toronto with a large firm and in Atlantic Canada growing another large firm. Just maybe talk a little bit about your experience about the differences in the markets.
Yeah, you know what? I mean, at the end of the day, the bond itself is pretty much the same. There's a few owners that have sort of minor differences from market to market, but the product itself is the same. Really, like it's sort of the way that the business is transacted, I think, is a little bit different. I think in Atlantic Canada, like I said, there's still some of those direct relationships where contractors are working with the surety and the broker's not always involved as much there. And sometimes that works and sometimes it doesn't. And I think at the end of the day, if you don't have that third party there that's involved in the deal and is determining whether or not that makes sense or not, and sort of where that deal sits in relation to the market, you might be doing yourself a disservice. And I think just because it's a little bit of a bigger market in Ontario, you get a bit more specialization. So in Atlantic Canada, where you get brokers that do sort of general insurance, you don't get as many of them that are true full-time surety experts, right, that you will get in the Ontario marketplace.
Right. And what are some of the ones in Atlantic Canada that would be experts in that, other than Intact? Would be Western Surety, Intact.
Oh, some of our competition?
Yeah.
Yeah. So Western Surety, we have Travelers,
Aviva.
Trisura, Aviva.
There's probably like
Sovereign. There's a number of them.
5 major ones
Yeah.
that take up most of the market share.
Yeah, sorry, I know I cut you off there, Andrew. Please continue. I just was curious.
Totally.
Yeah.
Totally. And so I was more talking on the broker side of things, but so I mean, when you don't have that specialist surety broker, it's almost like having your car mechanic fix your boat, right? You can probably struggle his way through it, but he's likely going to miss a lot along the way, right? And so I think that's a little bit of the difference, and it's slowly starting to change. I think the Atlantic market is growing. You're seeing some pretty solid population growth, especially in Nova Scotia, and like Jen and Ryan talked about, tons of development interest in Halifax, tons of construction there. So you're starting to see the market in Atlantic become more sophisticated, and because of that, there becomes more of a demand for specialist surety brokers to get involved in those deals and help contractors navigate what bonding looks like when you're doing a P3 project, or whether you're doing a joint venture, or whether you're getting into a complicated or sort of novel field of construction. So.
Yeah, maybe I know if we want to start talking about the financial realm or payments, like there's no end, But just maybe from a simplistic perspective of a subcontractor with a performance bond bidding to a general with on a bonded job, they're, within their bid allowance of the project, they're carrying a 1% amount because that money is being paid, and obviously that's not money that's coming back to them.
Right.
What about the payments? Like they're paying up front, and that money is going to a money pool for the owner. And the same thing's happening with the bid bond from the general, and all those payments are happening before the project starts, or
Right.
Yeah.
No, you're right. Those are upfront costs.
right.
For sure. And, it all works up the line and it also works down the line in the
Right.
sense where, it's an upfront cost for the owner because they want that bond up front. They want to make sure that contract is covered. Right. They're the end user. And should the general want that extra assurance, then they'll get it from their subs as well.
Yeah.
And again, it ends up being a flow through.
Right, and so this is an issue outside of the public domain with private developers, whether or not they want to spend that extra money to be bonded and be more protected.
Right.
Yeah, and
That's usually what will happen at times, that they just don't want to put that money into that protection. But I mean, for 1%, I mean, it's a
Yeah,
pretty,
so
it's
if
a pretty good thing to have. I
right.
mean, and
So
they-
if 1% of a $50 million development or
exactly.
something, then
And that's where you can even get into, like, sometimes they'll use the like letters of credit instead.
Sure.
They'll use that for
Yeah.
security. And the bond has a lot more benefits only because, at the end of the day, the bond is in place for the owner, but if there's actually a default, the surety company is going to do an investigation. The
Right.
claims team is going to do an investigation and see, who's right or who's wrong. They're going to go back to the terms and conditions of the contract, whereas a letter of credit won't do that. There's a letter of credit outstanding, maybe 1% of the contract.
Yeah.
And is the 1% of the contract amount, if there's a true default, is that actually going to get that building built, or is it going to, because at the end of the day, that bond is the owner wants, say if it's a building, they want a building built at the end of the day, and a bond's going to do that because
yeah, it's going to keep things moving if there's
it's going to
problems.
either
come
pay
up.
out under the bond penalty or find a replacement contractor or a number of different remedies. But with a letter of credit, you're just like, the owner's standing holding money, but
Yeah.
what's that really going to do for them at the end of the day?
Yeah, and that's holding back when your building's open, it's holding back your
Exactly.
cash flow. And all those
Exactly.
sort of things. Yeah.
Exactly.
To me, that almost creates an imbalanced relationship. When the owner is holding that hard security, they're holding all the cards. The bond balances it off a little bit better because now we basically have two customers in front of us. We have our contractors who,
And that's a
Andy
number
and
of
I-
customers, yeah.
oh yeah, and we represent them and we vouch for them and we champion for them. At the same time, those owners are also our customers because they're the ones that are asking for the bonds. They're the ones that want the protection. So we have to make sure that the relationships between all three parties stays as fair as possible.
Definitely.
Anything to add, Andrew?
Yeah, I think it's a great distinction, right? Like some owners are competing products out there to bonds, right? You've got letters of credits, you've got bonds, you've got people asking for cash. And like Brian said, a letter of credit, or if you give the owner cash to secure something like this, they can just cash that at any point if they deem there to be an issue with the project and there's nothing you can do. So they have a pretty big hammer there. Whereas the bond itself it's a default instrument, right? So once the owner says, hey, I got a problem on this project, the surety is going to go into investigation mode and they're going to ask the contractor for their side of the story and their documentation. They're going to ask the owner for their side of their story and their documentation and look at the contract and determine whether or not there's a real problem there. And after that, if there is, then they'll make a payment, right? So it sort of evens that playing field a little bit between the owner and the contractor while still providing that owner with a really solid, highly rated guarantee.
Can you give an example of some of those investigations that you've been either kind of collectively part of in the past, whether it's a contractor who didn't use the right material or one that couldn't carry out the work for any number of reasons, or just any specific examples to give on that front?
Yeah, it's surety bonds, like different than insurance. It's not a frequency scenario when surety companies pay out. It's more of a severity situation. So when you're working at a surety company, and you guys can speak to this as well, but you're often getting involved in disputes where the surety company is not actually making a payment, right? So you've got a contractor that's frustrated, an owner that's frustrated, they're not seeing eye to eye, there's maybe delays in schedule, but there's not a default there that makes sense, right? Because at the end of the day, if the surety involved, they've got to take that contractor off the job, they've got to retender it, they've got to get a new contractor in there. That's not good for the contractor, that's not good for the owner, and that's not good for the surety. So those dispute scenarios tend to get worked out. So when you see real claims dollars get paid, it's typically an insolvency, right, where the contractor's in real financial trouble. And at that stage, once they're in that position, your sort of options to help and to mitigate that become a little more limited as you work through that situation.
I would agree with that, and I would say that the non-financial situations, that's one of the benefits of having a bond in place, because we can help navigate through that before there is a claim scenario. You know, there may be a dispute, there might be a disagreement, and even the mention of getting the surety involved sometimes helps progress that issue.
Yeah.
I would say
It's kind of like getting a lien letter in the, you know, it's not
right.
there yet, but
Yeah.
it's like, hey, let's get things figured
Yeah,
out.
for sure.
And we handle like all of Atlantic Canada. So, you know, you're talking some bigger cities, some smaller cities and towns and that sort of thing, where we might not be aware of the ongoing personality conflict between two individuals, you know, in another
Sure.
province, until, you know, we get involved and find out one guy just doesn't want to do what the other guy is telling him,
Yeah.
even though it's part of the contract.
Yeah.
Well, then once you explain to them what the bond is for, why it's there, what our options are, a lot of the times the situations get resolved.
Pretty
Right?
quickly. Usually,
I would
yeah.
say, you know,
Yeah.
9 times out of 10, any potential bond issues, claim issues are resolved before we even receive a letter, you know, stating that the bond is in default.
Yeah.
And-
Once the sense of urgency is there
Yes.
and things like that.
Exactly. And like Andy said, it's the insolvency issues. It's when the contractor no longer has the ability to do the work is when we have another set of
Whether that's a
options in
labor
front of us.
shortage or a cash flow issue, or they can't buy the material, or they can't pay and they're in financial trouble, any of those kind of things, right?
And that's a great point, because, you know, and I'm sure Andy and Jen can both agree that, you know, when we're looking at our contractors initially and ongoing, we're focused on their profitability. We're focused on their solvency and their liquidity. We want to make sure that they're able to meet their short-term obligations.
Yeah.
And, you know, it's the heavy lifting comes at the very beginning of a relationship, and we're trying to learn as much about the contractor as possible in a very short period of time. And then after that, it becomes a maintenance issue. And barring any out of the ordinary events, you know, it's a regular relationship.
Yeah, and Andrew, Jen, and Ryan, I mean, you know, you guys, you know, involved in the industry, but those that are outside the industry realize that, you know, some of the projects, some of these large developments, you know, these are contracts that last anywhere from 2 to 5 years or sometimes more, right? So these are big, multi-million-dollar, multi-year long projects. So and serious agreements, and that's what you guys are there for when things get to the point where things are at that stage or something needs to be corrected. And like you're saying, usually 9 times out of 10 that'll happen.
Yeah, that's a good point that Ryan made. Like the surety is a short-term creditor, and it's something for people to remember, because that's why there's always when we have a client, there's ongoing maintenance of that client. We're not just looking at financial statements, you know, once a year or once a blue moon. We're quarterly looking at financial statements, looking at work on hand reports, talking to them, looking at receivables, just like talking to them about the marketplace.
And they might have multiple bonds with you.
Exactly.
In
Like
tandem,
a general
right?
contractor perhaps will have a number of different jobs with us on the go at one time, so a number of different bonds. So
And so does that factor into each one if there's multiple bonds in place already and another one's requested, with it being too busy or maybe too much on their plate, as far as opinionated? But Andrew, is that, or Ryan?
Yeah, I was just going to say, and when we're setting up a facility, think it almost like you're applying for a line of credit with the bank. You know, the bank will determine what your maximum limit should be based on your needs and your qualifications. We do something very similarly in trying to assess what that right number is. I think it's more of an art than it is a science sometimes, because we have to take into consideration the needs of the contractor as well. You know, if they only qualify for this much, but they want this much, then there's an issue, or vice versa. You know, that makes it easier if they qualify for that and they only need
much
that,
easier.
then that's easier. So they tell us what they plan to do in the run of a year, and if that falls within line with the financials and the other factors that we take into consideration, we may set them up a facility of X amount of dollars. As those jobs, as they fill those that program up with those jobs, the available credit comes down a bit, and unlike a bank, and Andy can chime in if he wants, but even if we get close to that limit, it doesn't mean we're going to say no, or we're going to stop, or say sorry, that's enough. We take everything into consideration. Maybe that limit that we currently have them at isn't enough for them. Maybe they qualify for more. You know, so we're always moving that needle. We're always moving that target, depending on so many different factors, especially now with COVID and
Well, let's face it too. I mean, prudence isn't always a virtue in contract. I mean, there's a lot of greedy contractors out there who want to do everything.
Right.
And you guys are having to mitigate that as well and saying, look, we can't surety you for this much work here with what we see on the back end.
There's a lot of pushing the envelope.
Yeah.
A lot of guys don't know when to say no, don't know when to stop. They want to keep building, keep growing.
Want to do everything.
And so based on historical data, you know, we have a general idea of what is too much and what's too little. So we know at certain thresholds when the risk starts to increase, right? So, you know, we do a pretty good job of managing that. And sometimes they're uncomfortable conversations. Sometimes we may not make the right call, but we're making the most prudent call because we're playing with in-tax money. You know,
Good point.
that's what we come down to. We're being paid to bet on the winning horses in the race.
Yeah.
And like to your point, like it's based on the 3 C's of underwriting. That's what we call it. It's character, capacity, and capital. Capital obviously is number one in the surety world, but if we have a client that wants to go after a larger job and maybe the financials don't quite cut it, if you have the capacities there and if you have the character is huge. Yeah. It'll get you a long way. We can maybe push, a job through. It's a little bit larger if it makes sense. Yeah.
Right. If it makes sense.
That will come down to your close relationship with that client here in Atlantic, Canada.
Exactly. Relationships, teamwork, communication.
Key.
Right.
And I'm sure Andy can agree. If a contractor has the ability to demonstrate to us why it makes sense to them, and they can articulate that to us, chances are we're going to follow suit. We're going to agree with them. Would you agree with that or disagree?
Yeah, like this is a great point, and one of the situations where a broker is so critical, right? Because as a contractor, right, it's not always this sort of clear and even path to growth, right? Opportunities arise, and you got to take advantage of them when they come up. And like Brian said, every surety company is a little bit different. They're looking at risk a little bit differently, and they've got to make calls that keep their firms in mind. And so what the broker does, especially a good broker, and you guys will see this, when there's a stretch project or a contractor's got a bunch of work on the go and they want to take on more, if you've got an expert on your side as a surety broker, they're going to know that, hey, there's other options out there, or maybe the surety company wasn't looking at this, right? They weren't clear on the composition of work, and there was some CCDC, construction management not at risk work in there, or whatever the reason might be. They can get that leverage up temporarily, or they can find you an alternate home where they see the risk a little bit differently. So that growth period often for contractors is where they can see some pain, and where a true expert can help sort of manage that process and make sure that you're able to pick up the opportunities that are difference makers for your firm.
Right. And like what we were saying before, a lot of contractors, I mean, they are greedy and they want to do everything. It's true. But then there's also times where a large project might come up locally, and it might be a chance to mobilize and all your volume of employees in one place. The schedule works out, but it's 10 times the size of a job you've done before. But that's when the surety company, where you know their character and stuff like that, you can come there and back them and give them a chance to take that opportunity.
Absolutely.
Yeah, for sure. Like the majority of our clients are actually, 20, 25-year relationships. A lot of them are long-term. So that plays a big, big role when they want to do something a little bit outside of the norm.
What about maybe the differences on your guys' end with the different types of projects, from lump sum or design build or CM? Like, how do you guys approach those bonds and surety situations? Is there differences in each category for you guys, or where there's more risk than others, or?
There is more risk than others, and we do look at each one with its own merits, I think is the best way to put it. For example, design build. We want to see a history of their ability to successfully complete design build projects. We want to make sure that they have the engineers on their team. We want to make sure they have the right coverages, because again, a design build in relation to a bonded project, if the insurance isn't adequate, the owner may try to go after a bond because of a design aspect. So the bond covers the contract. Whatever are the obligations under that contract, that's what the bond covers. So there is an added risk for those types of contracts. I don't know, Andy, if you wanted to talk about any of the other types there and how we may underwrite those differently.
It goes back to your point there, Dan. You were talking about sort of what causes losses and sort of where the issues are for sureties, right? We talked about bankruptcy, but then what's the cause of the bankruptcy? And I think at the end of the day, in most cases, it's project issues, right? And the project issues can span a whole number of factors, right? From a job where the estimate wasn't right, to a labor shortage, to a material price escalation, to just not understanding the contract that you were actually signing, right? So in the surety world, obviously the majority of the contracts that are bid for government entities are stipulated price lump sum contracts, but you've got the design build contracts out there, you've got construction management, and those for a GC, if you're thinking about a GC specifically, those present different risks for a GC. For example, if a GC signing a construction management not at risk contract, he's not holding the subtrade contracts himself, right? The owner is signing direct contracts with the subtrades, and the GC's gonna manage the project and gonna take a fee for that. The risk for a surety for a project like that is completely different than a project where they're signing a lump sum contract, they're doing all the subtrade contracts direct, and they're managing them. Because at the end of the day, in that scenario, if there's a subtrade issue, that's a GC's problem. Whereas in a not at risk contract, it becomes the owner's problem, right? So there are subtle differences, and like Brian talked about, if a contractor's backlog's getting really, really high and they see that next opportunity, part of sort of getting that next opportunity is looking at things like this and saying, okay, well, we know the backlog number is X, but what is that actually made up of? Where are these projects in terms of completion? What types of contracts are we looking at? Where's the contractor going over the next 12 months? And building that narrative that helps secure that next opportunity point.
I'm thinking of, coming from a contractor's background, just having experience with, performance bonds and filling out the paperwork and trying to get it done a week before the closing date, and then having to go maybe to Western Surety to get a seal and pick up the bond and drop it off at general contractor's office or procurement office at the airport or Dalhousie or something like that. But just thinking of it.
Look, you loved it.
What's that?
Sounds like bonding was your favorite part of the day.
Oh, yes, totally. What about the shift to digital bonds? Explain a little bit about that. That's a current kind of trend, and I know a lot of contractors are seeing that now as an option.
It's not too current. I mean, it's been, I think, across the country. It's been definitely in play a lot more than it has in Atlantic Canada.
Right.
I find that COVID, though, really pushed through the digital bonding. But the thing is, the terms are used so loosely.
Yeah.
Digital bond, e-bond, PDF copy, scan bond, right? So, you're reviewing these tender specs, and
yeah, that's how I feel
everyone's
too.
putting their
As a
hand,
contractor, like, can I just email this to someone,
right,
or how does this work?
So, like, which one is
Yeah.
it? But so at the end of the day, like, a PDF scan version is not technically a valid, verifiable bond, because you can scan that off, and someone can
even if it has a company seal and it's scanned,
if it has a
it's
company
still
seal
not.
scan, it's not. It's going to work, and owners
Yeah.
are accepting it, especially due to COVID. There was they're accepting things much easier that way because they just email it in. But it's not technically a verifiable bond. So we are seeing owners like HRM, for example, is one that's using that system. And so it's you have to go through like a verifiable service provider. And through this provider is these bonds are going to be uploaded with verifiable signatures and seals and going through the right process to get the bond to the right place. So those are the ones that technically are digital bonds, are the verifiable ones. But a lot of owners haven't really shifted to that route yet. They're still accepting the scanned versions, which as long as it's okay with them, that's fine with us. But technically, they're not verifiable bonds.
I've got a question. Would you accept a photocopy of a $20 bill?
That's a great analogy.
Yeah, it is really, really good.
That's how I explain it to them.
Yeah.
Right.
Now, 15 years ago, I think we started delving into digital bonds.
So maybe it's more current in Atlantic Canada than
Necessity is the mother of invention, right? It wasn't until COVID that really pushed it to the forefront. I mean, there are some owners who were early adopters. Some weren't. Again, maybe in other parts of the country, there are other larger municipalities who got on board earlier. I find when it comes to the change in process, as far as bonding goes and what we do, I think we kind of follow suit in a lot of circumstances where, you know, if it's worked in Ontario, if it's worked out west, then we'll consider it. You know, I think COVID really, with everybody working from home and that
So
sort
are we
of thing,
moving toward all digital bonds then?
Slowly.
Slowly.
I think slowly.
Eventually, I think.
It's going to be more of us, though, educating the industry and educating owners about what they really are. I mean, there's a lot of benefits to it, right? I mean, you can sit at your desk on the day of closing and just hit a button
Well,
and it's going to be uploaded.
that's why I brought that up earlier.
Exactly.
Run
I mean, it
into
makes
the surety
sense.
office,
You're not
run into the
exactly. You're not running
procurement
around
office. Yeah.
trying to get the bond in place.
Postage,
Yep.
couriers, paper, ink. You know, there's so many different cost savings involved.
Environmentally friendly.
Environmentally friendly. I mean, talk about verifiable. I had an owner contact me 15 years ago to ask me if a particular bond was real or not because there was whiteout on it where something had been changed, but it wasn't done by the surety. It was done by the contractor trying to bid a job that wasn't approved by the surety. So at least that owner had the wherewithal to contact us directly saying, is this real? Well, if it was a digital bond, a true verifiable digital bond, that wouldn't have been a question.
Right. Andrew, what percentage of the bonds that you're dealing with or that you're seeing, I guess, as a broker, 70% digital bonds in Ontario and West, or?
It's way more now. I think it wasn't too far different from what Ryan and Jen were dealing with in Atlantic Canada. It was prior to COVID, it was still a lot of paper bonds, which is hard to believe, eh? Like we're in 2020,
Crazy.
we're still issuing paper bonds and mailing them around. Like as an industry, we need to get our act together and sort of come into the 20th century, really. But slowly it started to happen, and COVID was really a catalyst for that. And like we said, it's massive cost savings. And honestly, I can't tell you how many times over the years you hear contractors where the purelator just didn't get there, right? Or the mail was slow and they missed their bid. And just, that's no good for anyone. That's not good for us. That's not good for contractors. That's not good for owners that aren't getting that bid in.
And just to jump in, like a lot of times it's not because the contractor's unorganized or unprepared or not following. Like it's because they're waiting right till the last minute to adjust their numbers as well, right? For the tender closing date.
Totally. And so this helps alleviate that. Right now, the bond isn't an impediment, right? It's if you're using digital bonds, and every owner in Canada should be accepting digitally verifiable bonds because it's good for everybody, right?
Definitely.
So you guys mentioned, a lot of the things that are happening during the last couple of years, and the things that you're paying more attention to with labor shortage, supply chain management obviously is a huge one. Material shortages, all that kind of stuff. I mean, you guys are looking at the industry as a whole. And I know we talked off air about just how, you guys are in bonding and surety with Intact and FCA, but your whole livelihood is dealing with construction and contractors at the same time. Maybe just talk about that unique dynamic, because you're not on a construction site helping build, but really you are helping build. If it's not for you guys, then a lot of these public jobs and private jobs aren't happening. So you're definitely a unique player.
Absolutely.
Yeah.
And I think you both probably agree that our workload, our workflow is dependent on the construction industry. When it's busy out there, we're busy. When it's quiet, we're quiet. Winter times, we don't get laid off, thank God. But we get to take a breath and prepare for the next bidding season.
Yeah.
We're definitely following the same wave.
And that goes for you as well, Andrew, with your position at a broker.
Yeah, for sure. Like, it's, I was thinking sort of as you guys were talking, it's, insurance is in a similar situation to contracting, right? It's not always doing a great job of attracting top talent. And for any kids or younger people that are out there thinking about careers, like the trades and insurance, you can have a great career in that. But unfortunately, a lot of people stumble into it and then only realize after they've been in it for a couple of years that it's a great career. But for me, sort of having a numbers background and sort of pairing that with construction was just, it was a natural fit. And it's just a real pleasure because you get to talk to construction owners every day because they're the ones often handling the bond aspect of things and understand their businesses and have those sophisticated conversations. And that's really a pleasure. So, and I think I've been in meetings with Jen and Ryan before and can tell they're the same way, right? They have that same passion for the business and see the same benefits and the enjoyment out of it.
Every day is a little bit different. You never know what you're going to get into. That's what's so exciting about it. I mean, it makes it so different from just regular insurance. It's like you never know what you're going to come across in your run of your day and the conversations you're going to have or what's going to come across your desk, but it makes it fun.
That's what sold me on it.
It makes it fun.
Yeah,
It does. But
you're there as the kind of like the older brother to these, just making sure you're there to
So
protect
true.
them, right?
We're there to protect them. That's a good way to put it. That's what I'm going to say. That's what I'm going to say next time when they
You
say no to
you
something.
can use that in your next marketing campaign for
That's it.
2022.
Yeah.
No, I've got the boots and the hard hat in my trunk.
Yep.
Because at the drop of a hat,
You never know.
hey,
Right.
do you want to come check out this building?
Yeah,
Because
that's part of a job that you
Absolutely.
love. That part of your
Absolutely.
job, right?
That's the best part.
Contractors love to show off their work. I mean, let's be honest. If
Oh, of
they're
course.
doing a good job and they're proud of it, they want to show it off. And who better to show it off than the guys who are bonding the job?
Yeah.
I got the chance to see some of these larger developments, when the concrete and the structural steel was up, and it was amazing to walk through. I mean, but the faces were beaming, right?
Definitely.
Just being able to show that off.
Yeah.
And, the next day we're reviewing financial statements.
Yeah.
The next day we're reviewing contract documents. I mean, it literally is.
Yeah, that's what I'm getting at. Is you guys are really kind of coming at things from a real holistic perspective.
Absolutely.
Yeah.
Absolutely. We do it all. Like we do. We don't just sit there and review a file. That's a lot of what we do. But like Ryan said, the job sites are the best part of our job, and that and going to meetings with our clients and our brokers.
Yeah,
too.
and like Andrew said, you're talking to these contractors every day, every week, and many of them
Totally.
all the time.
And they love sharing their business for the most part if it's good.
It's kind of like they say, if you're a business owner, you have to have a good relationship with your accountant. Well, you have to have a good relationship with your surety
Yeah.
broker as well.
That's right.
But it feels pretty good when you're the first one that your broker or client calls for some advice, or if they want to bid a larger project
Yeah.
or whatnot, and they're asking you, what do you think first? It feels pretty good.
Yeah. So I can hear some people that are maybe coming out of university or maybe thinking of going the insurance route or maybe don't know a lot about bonding and surety, like Andrew said. And if they're tuning in, hopefully you'll pique their passion and interest in this field, because it sounds like you're, definitely, it's not just a task-oriented career. You're always doing something different and out there socializing on job sites one day and financial stuff the next. And
That's where we need to do a better job, is even getting out in front of like job fairs or universities and like sharing like this is a job too, because none of us probably would have known about this line of business had we not fallen into it. That's usually what happens.
anything to add, Andrew?
No, I think that's all spot on. And like I said, I think the same challenges we have, construction has, right? You want to get good, young, top talent into the business. And I think we really have those issues in common. And I have those conversations with contractors all the time, right? Like, how you're finding labor, how you're dealing with it, where you're getting it. And a lot of it is still relationship based, right? Because it's still a challenge, and there's still a big labor shortage getting new people into the business. So it's more talent just moving from shop to shop rather than fresh new talent coming in. And fortunately, a lot of the associations I know in Nova Scotia, they're doing it. I know in Ontario, they're doing it, but they're spending a lot of time in trades programs and working with different schools and universities and with the government to get funding to make sure that people are getting into the industry, because it's a phenomenal career, whether you're talking about construction or whether you're doing surety or insurance. Like, they're great careers.
Well said, Andrew. I'm just thinking from a perspective, if there's a subcontractor tuning in or just started a new company, whether it's roofing or electrical, this wouldn't go as much for the generals who are used to dealing with surety and bonding on most of the projects they do, the tenders that they're bidding on. But if a contractor's wanting to start bidding some larger jobs and they're growing their business as a subcontractor in any scope of work, it's basically as simple as reaching out to a broker like Andrew with FCA or in Toronto, or someone local with Atlantic Canada, and they'll line you up with a surety company and sort of just take you through the process. It's basically that simple. Is that correct?
It's that simple.
Yeah.
Quite often it's a cup of coffee. It's
Yeah.
a lunch. It's nothing for us to get a call saying, this is what we're looking to get into. Can you give us a few pointers?
Yeah.
Absolutely. And again, a lot of the times, most of the times, the first step was calling the broker. That's been the first step.
Because the broker is going to know the
Where to
markets,
direct you.
where to direct them to. They're going to dive into the contractor, ask questions, find out everything that they can about them, and then they're going to be their biggest advocate. Let's figure out where a good home is for you.
Right. Well, guys, I know there's lots of different things that we could drill into. I mean, we could talk for days about the financial end of things within surety and bonding and stuff. Is there anything we didn't touch on, Andrew, Ryan, or Jen, that you guys had kind of in the back of your mind or wanting to either promote for Intact or FCA, or just anything that you kind of wanted to mention that didn't come up?
I think first and foremost, we do a pretty darn good job of representing Atlantic Canada. We advocate for all the construction associations in each province, and we're there to support our contractors. And again, I know I've mentioned it before, but it's all about the relationships for us. It's all about the teamwork, and it's about the communication. And to me, those are kind of the three paramount pillars of our business.
That's good. I second that.
Anything else, Andrew?
I just want to thank you, Dan. I appreciate you starting out something like the Atlantic Construction Podcast and really sort of shining a light on top contractors in Atlantic Canada. I mean, personally, I've got a super soft spot for Atlantic Canada because my wife and I, when we were younger, we moved out there and obviously lived there for a number of years, and I did the surety thing in the provinces out there, so I got a super soft spot for it, and still spend a lot of time out there with some of our clients at FCA, but just really glad you're doing this, and want to see you keep doing it, and happy to be part of it and happy to support whatever way we can going forward.
Well, thanks for the kind words, Andrew. That's Andrew Cartwright with FCA in downtown Toronto, videoing in here in Halifax. And we have Ryan Brady and Jen Love from Intact Surety. Thanks so much for doing this, guys, and hopefully it'll be an educational platform people can go and listen to again if they want to get some information, and they can reach out to you guys with their social media connections and things like that. So it's been great having you guys here, and really appreciate your time.
Yeah, thank you very
Thank
much.
you very much.
Appreciate
It was
it.
a pleasure.
And
And Andy, hoping to see
we
you
have a soft
soon.
spot for Andy too.
Yeah,
We miss you, buddy.
everybody
We
likes
miss you.
Andy.
Yeah. Come visit us.
Well, we'll see you in Atlantic
Well,
Canada.
hopefully we'll be out there soon and we can grab a beer at the old Triangle.
That sounds
There you
good.
go. All right, Andrew, Ryan, and Jen, thanks so much.
Thank you.
Thank you.
Cheers. Thanks for tuning in to this episode of Atlantic Construction Podcast. Be sure to follow us on any podcast platform you use. You can also find us on LinkedIn and Instagram at Atlantic Construction Podcast. Be sure to send us a comment or a review. We'd love to engage with you.